Welcome. Today, we are examining our strategic roadmap for navigating the AI capital cycle as we look toward 2026 and beyond. As you can see on the left, we are currently navigating a period defined by heightened volatility and clear bubble signals. This phase, marked by rapid fluctuations and the inevitable capital squeeze, requires us to be exceptionally disciplined in our deleveraging efforts. However, as the market matures and the initial turbulence subsides, our strategy transitions into a more structured, long-term asset allocation model. We have categorized our forward-looking approach into three distinct pillars. First, we prioritize resilient assets. This represents our infrastructure core, the stability anchors that provide the foundation for sustained value. Second, we are targeting future growth by identifying emerging markets and tech frontiers that serve as powerful diversification vectors. Finally, we are establishing hedges through scarcity plays and alternative stores of value, ensuring a long-term vision that protects against future systemic shocks. By understanding these dynamics, we can successfully move from the reactive volatility of today to the proactive strategic positioning required for the next decade. As we approach February 2026, we reach the pivot point. This period is defined not by a total crash, but by a polarization and selection phase. The market is shifting from indiscriminate buying to a focus on quality filtering. The necessary action during this transition is strategic deleveraging. This strategy requires us to cut weak links, specifically unprofitable AI, to reinforce our strong assets, the cash flow kings. Looking at the future, we see a clear evolution in capital flow. While our current focus is on infrastructure, the 2030s will shift towards application, ultimately leading to a market defined by scarcity in the 2040s. As we analyze the market trajectory toward February 2026, our modeling identifies three key scenarios. The most probable outcome, at 60%, is Scenario A, a cleansing correction. This path entails a soft landing for the broader economy, but a necessary sector purge. Under these conditions, we expect the Magnificent Seven to see corrections between 30 and 55%, with only the strongest companies surviving the transition. Scenario B, a hybrid bubble burst, holds a 25% probability and would be marked by debt failures and an S&P 500 decline of 25 to 45%. The most extreme possibility, Scenario C, is a dot-com crash 2.0. Although assigned a lower 15% probability, it represents a major failure and a market wipeout exceeding $20 trillion. Currently, we are positioned in the late expansion or early cracks phase. The directive for investors is clear: prepare for a cleansing of market excesses, not necessarily a total apocalypse. The focus must remain on quality and resilience as these risks materialize. The current economic landscape for 2026 is defined by 8 critical warning signs that demand our attention. First, the CapEx versus revenue gap has reached a tipping point, where massive infrastructure spending is not yet yielding proportional returns. Second, project abandonment is on the rise, with over 30% of proof-of-concept initiatives being scrapped. Third, the SaaS sector is facing a severe equity contraction, with valuations down 30%. Fourth, structural instability is high due to the 4 overs. The market is overvalued, overinvested, overleveraged, and overowned. Fifth, aggressive low-cost models from China are systematically destroying industry margins. Sixth, a fragile loop of circular financing has emerged, where startup funding fuels cloud spending, which in turn drives GPU revenue. Seventh, we are encountering hard physical limits, including power shortages and significant construction delays. Finally, liquidity reversal and CTA deleveraging signals suggest a fundamental shift in capital availability. These indicators collectively suggest a period of significant volatility and correction ahead.
This slide outlines our approach to strategic deleveraging. On the left, you see total market exposure, represented as a chaotic, tangled web of various investments and market noise. The core objective of this strategy is to move from this complexity toward quality concentration. To achieve this, we utilize a strategic filter, represented here by the prism. Within this process, we must identify and eliminate weak links. We are specifically focusing on risk reduction by divesting from speculative pure AI themes and unprofitable SaaS companies, the volatile elements that represent significant downside in the current environment. By filtering out these weaker components, we refine the portfolio into a streamlined selection of high-quality assets. As shown on the right, these consist of cash flow kings and essential infrastructure plays. Our guiding mantra for this transition is simple yet disciplined. Don't sell blindly. Cut the weakest link and reinforce the strongest link to ensure long-term stability and resilience. The 5-step execution plan for the first half of 2026 centers on strategic defensive positioning and capital preservation. The first step, the immediate cut, involves reducing exposure to pure AI themes and SME stocks by 50 to 80%, prioritizing an exit from assets characterized by high capital expenditures and low monetization. Following this, Step 2 focuses on the keep, where we concentrate on high-quality cash cows within the Magnificent Seven, targeting firms with superior free cash flow to CapEx ratios such as Microsoft and Alphabet. In the third step, the hedge, we will implement protective measures by purchasing S&P 500 puts, utilizing covered calls, and maintaining VIX positions to manage volatility. Step 4, diversify, requires a rotation into resilient sectors such as energy, copper, and cybersecurity to broaden our market footprint. Finally, Step 5 is to cash up, establishing a target of 15 to 35% in cash or short-term bonds. This strategy ensures we maintain the necessary dry powder to capitalize on market dips as they occur. The 2026 model portfolio is designed for a mid-risk, mid-return profile, with the primary objective of ensuring survival while maintaining exposure to long-term trends. The largest allocation, at 30%, is dedicated to Mag 7 selects, focusing exclusively on cash flow positive giants to provide a strong equity foundation. 20% of the portfolio is directed toward indirect infrastructure, which includes essential materials such as energy and copper. To ensure liquidity and stability, 25% is held in cash and bonds, specifically short-term treasuries. 5% is allocated to crypto, utilizing Bitcoin as a scarcity play. To protect against market volatility, an 8% hedge is maintained through puts and VIX-related insurance. Finally, 12% is invested in defensive growth sectors, specifically cybersecurity and health AI. This diversified structure aims to balance capital preservation with growth in key emerging industries. These are the critical monitoring triggers, essentially the kill switches for our current market positioning. If these indicators flash red, the mandate is to accelerate deleveraging immediately. We are monitoring 5 specific areas. First, we are watching CapEx guidance for any signs of it remaining flat or trending down versus 2025 levels. Second, we monitor credit spreads, where a widening of more than 50 basis points in credit default swaps would be a major warning sign. Third is revenue growth. We are looking for Q1 or Q2 growth that falls below the 30% threshold. Fourth, we track CTA flows, specifically watching for daily liquidations exceeding $10 billion. Finally, we must monitor valuations in the private sector, specifically looking for any down rounds involving OpenAI or Anthropic. Any one of these signals entering the red zone necessitates a rapid shift toward de-risking. The long horizon chart outlines the strategic evolution of value from 2026 through 2050, illustrating a fundamental shift in where capital will be deployed over the coming decades. We begin with Phase 1, spanning from 2026 to 2030, titled Building the Brain. During this period, value is concentrated in infrastructure and hardware. This involves massive investment in data centers, specialized semiconductors, and the foundational compute capacity required to power advanced artificial intelligence. Moving into the next decade, from 2030 to 2040, we enter Phase 2, Using the Brain. Here, the value proposition shifts toward application and robotics. The intelligence developed in the previous phase is integrated into the physical world and software ecosystems, driving productivity through sophisticated automation and robotic systems that can perform complex manual and cognitive tasks. Finally, between 2040 and 2050, we reach Phase 3, What the Brain Cannot Copy. As digital intelligence becomes abundant and eventually commodified, the market focuses on scarcity and real assets. This includes land, raw materials, and unique physical environments, assets that artificial intelligence cannot synthesize or replicate. The core thesis of this progression is that surplus capital will move from building intelligence to owning the scarcity that intelligence cannot replicate. Phase 1, titled The Build-Out Peak, covers the period from 2026 to 2030, where the primary focus is on foundational infrastructure and hardware. The central thesis of this phase involves a massive influx of capital into data centers, energy, and semiconductor chips, with cumulative capital expenditure projected to exceed $3 trillion. The key assets identified for this stage include semiconductor leaders like NVIDIA and AMD, energy sources such as small modular reactors, copper, and uranium, and the physical real estate managed through data center REITs. However, a critical risk to monitor is the potential for overinvestment. Much like the fiber optics bubble of 2000, there is a possibility that this aggressive expansion could lead to a market bust around 2028. Phase 2, covering the decade from 2030 to 2040, marks the arrival of the productivity explosion. During this period, the strategic focus shifts toward the integration of software and robotics. Our core thesis suggests that as infrastructure costs continue to decline, the utility of these technologies will skyrocket, leading to a labor replacement rate of approximately 50%. The primary assets driving this phase include humanoid robotics and logistics, led by projects like Tesla Optimus, as well as AI operating systems, represented by Palantir, and the expansion of healthcare AI within the biotech sector. However, this era of rapid advancement carries significant risks, particularly regarding potential regulatory crackdowns and intensified conflicts over data privacy. Moving into Phase 3, we entered the Age of Scarcity, a period projected to span from 2040 to 2050. The strategic focus during this decade shifts toward real assets and the uncopyable. The central thesis here is that in a post-AGI world, the cost of labor drops to near zero. As a result, capital begins to chase what artificial intelligence cannot generate or replicate. We categorize these priority assets into 3 primary groups. First is absolute scarcity, which includes gold, Bitcoin, and prime real estate. Second is the expansion into space, focusing on satellite networks and the acquisition of off-planet resources. Third, value is placed on unique experiences, specifically luxury and human-centric services that require a personal touch. Finally, we must consider the critical risk associated with this era, the potential for extreme wealth concentration, which may lead to significant social instability. As we examine the structural changes ahead, we are increasingly looking at what is termed a K-shaped future, characterized by a stark divergence in economic outcomes. On the upward trajectory, we see the dominance of capital owners and those who control scarce assets. As automation continues to scale across industries, the ownership of these assets is moving from a luxury to a mandatory requirement for economic survival and growth. In contrast, the downward trajectory represents the outlook for labor and commoditized services. Here, we anticipate a stagnation of labor income as human output faces increasing competition from technology. This pressure is compounded by the polarization of energy prices, which creates further volatility for those reliant on wages. Finally, this shift extends into the realm of geopolitics. We are seeing a redistribution of global influence, where neutral, resource-rich energy states are gaining significant power. These nations are becoming increasingly dominant over chip-locked nations, those whose economies are vulnerable due to their reliance on restricted technological supply chains. This K-shaped transition signifies a fundamental reordering of both wealth and global power dynamics. Our immediate tactical priorities focus on de-risking and ensuring liquidity. You should evaluate your exposure to the Magnificent Seven, retaining only those companies with exceptionally strong cash flow. This is also the time to exit positions in unprofitable AI pure plays and SaaS companies with significant exposure to the Chinese market. Our objective is to bolster stability by increasing cash and bond allocations to over 20% of the portfolio. In terms of monitoring, we must keep a close eye on 2 critical indicators: big tech capital expenditure guidance and credit spreads. These will serve as our primary gauges for market sentiment and corporate investment health. Looking toward our long-term strategic future, we are preparing for a series of major pivots. We anticipate a transition from the current dominance of semiconductor chips toward robotics in the 2030s, ultimately shifting toward real assets in the 2040s. Aligning your portfolio with these multi-decade shifts today will ensure sustained growth through the coming technological cycles. To conclude our discussion, let's focus on the final takeaway. As we navigate the age of artificial intelligence, we must recognize that value is fundamentally shifting.
It is migrating away from the tools of intelligence themselves and toward the things that intelligence simply cannot create, those uniquely human or tangible elements that remain beyond the reach of algorithms. Our objective is not merely to capitalize on current market momentum or ride the bubble. Instead, the strategic goal is to effectively transfer the wealth generated during this period into enduring assets that will stand the test of time.